Hello traders, this is Stephen Place from investingwithoptions.com, where we teach people just like you how to become great option traders. Today we're taking a look at a short trade in gold. Now, I do believe on a longer term time frame that gold has bottomed, and odds are, give it enough time, it's probably going to run back into the 1500 level. This is the previous, let's see if I can draw this really quick, the previous support right here that will most likely act as a magnet and become potential resistance. This is a weekly chart, which means it's probably going to take a lot more time than what people think, and there's probably going to be pullbacks along the way. As it stands right now, gold is up 6 weeks in a row. Now, this is not unprecedented, but it doesn't happen very often. We've seen enough buying pressure to have no pullbacks whatsoever over a month-and-a-half time frame. Within the past 5 weeks, gold has rallied 10%. Again, not unprecedented, but it's coming into a level in which we should expect the rate of change to start to slow down. Now, if it doesn't, that means we've gone very parabolic. But as it stands right now, we're approaching overbought conditions, and we're coming into some big resistance levels basically from the past, what is that, since 2013. So we have some simple pivot levels right around 1381 to around 1420. And these levels, the last time they were tested, it was back in 2013 and the beginning of 2014. Given the amount of energy that gold has spent to run up to these levels, it does make sense for gold to either auction down a little bit to have a slight pullback, or for it to go sideways and we see a time-based consolidation. Now, if we zoom into a daily chart, you can see that there are several gaps going on right here. And technically, because we're looking at gold futures, the gaps don't actually happen. We can look at the overnight trading session, but it serves as a pretty good reference point. So we have a very large gap right here. I'm going to assume for now that that's going to be a breakaway gap, and that won't get tested. However, if we look at some of these other gaps, we have had one gap here, another gap here, and finally this third gap coming in right here. When we tend to see multiple gaps higher in a row, it's starting to signal exhaustion. It's starting to signal buyer exhaustion. And as we start to come into these levels that we highlighted back from 2013 and 2014, we should expect the stock or the ETF or the futures market to start to slow down and either pull back or start to go sideways. The trade structure I like here is going to be bear call spreads, and we'll get to that in just a second. But one more thing we can do is we can put on an extended hours trading session, so you can remove the gaps. And what's interesting here is that if we look at a measured move pattern, we're also coming into some big levels. So take the lows from May 31st, and the first impulse higher was about a 10% move to the upside over a 16-day period. Now, if we take this same kind of move and we assume that we get the same kind of move based off of that big move back when the Brexit happened, we're coming into the similar kind of magnitude run. But you can see that it's actually taking a shorter amount of time, which means that the rate of change is starting to increase, which means we're starting to get a little bit more parabolic. So bear call spreads here make sense. That's a trade where you make money if the stock goes sideways, you make money if the stock goes down, you make money if the stock goes up, but just a little bit. I do advocate a scaling approach. With those bear call spreads, I would go out to August options expiration, and I would use GLD, the ETF, as a proxy instead of using gold futures options. It's just my personal preference. A reasonable risk reward here is going to be something like this. This is the gold August, 138, 141 bear call spread. Your maximum risk is $250. Your maximum reward is $42. So that's about a 20% return on your risk. I would scale into the trade. So enter at 42. It's probably going to be up to about 45 or 50 cents on this gap higher. Enter at 42. Enter at 60, enter at 80, and then if gold manages to close above 139, you just close out the trade for a loss. In order for that to happen, you would need to see a move all the way up here. Now, is it possible? Yes. Is it probable? No. All right, you're probably going to see pullbacks within that. You're probably going to see time decay within that as well. And so this is a pretty good high odds setup, and it's a pretty good high odds fade. It's a little easier to short parabolics on futures markets because you don't really have earnings risk. You don't have to worry about a stock getting bought out by a competitor. Okay, gold is gold. It's not going to go bankrupt. It's not going to get bought out or anything like that. So you don't have to worry about extreme event-based risk. So if you like this idea, check out my service over at investingwithoptions.com. I look forward to seeing you on the other side. Have a great day.